Good morning and thanks for watching. I'm working more today on my stock market model. I'm getting ready for paper trading tomorrow. I'm going to start paper trading my first strategy. So that's what I'm going to be working on today, as well as some more portfolio level stuff. So before I get into it, let me talk about the goals for the project, what I've done so far, and what I'm going to be working on today. And I work on this every day, so if you're interested in the stock market, Python, programming, AI tools, AI for programming, tune in because that's basically the things that I cover here. So I have two goals. My first goal is to beat the S&P 500 by a significant margin. The S&P goes up on average 6% per year. I want to do significantly better than that, get 3 to 4 times that, and get 18 to 24% per year. I have the caveat though that it should be market neutral. So it shouldn't matter if we're in a bull market or a bear market. The strategy should give reliable returns no matter what. And so in order to do that, I've implemented a long short strategy, going long on the highest predictions, going short on the worst predictions. So I have data going back to 2011. You don't want to use all of that, so you have to isolate the stock universe as the first step. I'm using real estate investment trusts, common stocks, and ADRs, which are foreign companies listed on the US market, because these all have similar price movements. Additionally, I'm only taking the top stocks by volume because I want the strategy to be scalable. If you can get a really good strategy going, you can sell it to quant shops and get funded on your model. But the only way for that to happen is if your model works on a lot of money. So in order for the model to be scalable, I'm only using top volume things. I'm feeding that into a model. That universe data and a bunch of features I'm feeding into a model. I refined which features work best for the model and targets. It should be predicting something like return relative to the market or sector. Basically that. And then once you have I have a couple of good returns models. So once you have a good returns model, the final step is to incorporate that into a portfolio strategy, take the model output, and decide how to allocate capital. So that's the final step. So now I have a second goal for this project. I'm writing all of this code in Python. So I'm open sourcing everything. Hey, Soulwater, good morning. How are you? Basically, I'm writing all of this code in Python, and so my second goal is to open source this and generalize the code base. So basically, anyone can use this. If you're interested in that, you can go to GitHub. The link's in the description. Download the repository, fork it. Let me know how it works. Let me know how I can improve it. And all of this stuff, the defining the stock universe, training and robustly testing the model, and then robustly testing the portfolio strategy, you can do all of that in under 100 lines of code. So check out the code if you're interested. Now let me show my model. Let's see what Soulwater says. The auction will take place 4 days duration for the auction. We got 60 players. Yeah, I agree. I was surprised how many people were there. So when's the auction? Is it going on right now? And how do you 10:20? That's the current time in India. Oh yeah, I know, but it's morning here. It's almost 10 a.m. here. But yeah, not morning for you. But otherwise, what time of day do I say it is? Maybe there's some guy watching in Europe. Maybe there's some guy watching in China. So how do I? China actually isn't too far from India, but maybe there's somebody in Hawaii, somebody in Europe. So yeah, how do I pick a time to say? I just got to go with the local time. Um, so this is the first model I had that was successful. The first reason I think it's good is if you look at the metrics in the red box, the top one is information coefficient, telling me the predictive power of the model, and the next four are telling me the stability of the model. And so it's meeting or significantly beating the threshold for every single metric. So that looks really good. But not only that, that's the chess.com group in which I added people. That's where the auction will happen. Okay, cool. Well, just let me know. Wait, so the auction's going on right now, and how do people tell who to pick? How do they tell how good people are? So not only do the metrics look really good, the decile analysis looks really good. Perfect decile analysis, the top decile, 90% and above, should be the best performing. Bottom decile, bottom 10% should be the worst performing. And that's exactly what we see here. Additionally, each decile is higher than the previous decile, which means that it's perfectly monotonic. So this is exactly the distribution we're looking for, with the caveat that this is the Sharpe return, not the actual return of the model. And finally, I looked through and did a walk forward analysis and trained a different model every year from 2016 through 2025 and tested it on those years. And it was getting above my goal metrics every single year. So that looked good. And so the final step was implementing a portfolio strategy. That turned out to be tougher than I thought. The first model was just tested from mid-2023 through the beginning of 2025. Through the end of 2025. And basically any strategy I tried to do with that worked really well. However, that wasn't the case when I did it on the full model going back to 2016, and it basically failed from 2016 through 2022. And so I tried some different models to see if I could troubleshoot this. I was able to, let me go down here. This top model here ended up doing the best. And so when I implemented this top model, the portfolio strategy on this top model, it did kind of simplify the problem. So it wasn't doing bad on the whole early regime. It actually did well on the early regime. Yeah, and so you see this. Then it did well later. Really only had trouble during COVID. And this one's optimized through COVID. Honestly, that looks really good. So I started looking more into the decile analyses, and I found this. So basically, there are these three different regimes. The early regime at the top, you see the decile analysis is inverted. So if you look at the chart at the far right, the bottom decile is performing the best, and the top decile is performing the worst. So you see this long-short strategy would have gone extremely negative in this time period. Same thing's true for this middle region. Although it's starting to converge towards the end. But same thing, basically big divergence, bottom decile is by far the best performing. And then in recent years, 2022 through 2025, we see the correct behavior, which is inverse of the previous regimes. Basically this is why the strategy is doing well after 2022. And why it does poorly in these early regimes. So I can't just fix that with a portfolio thing. I think I need a better core model. So the Sharpe ratio gave really good decile plots, but rather than doing the Sharpe ratio, rather than predicting the Sharpe ratio, I tried predicting the returns. And so you see here, this is the returns decile analyses. And so these look way worse than the Sharpe ratio. And so if you just look at the decile analyses and these metric plots, you would assume that these are clearly worse than the Sharpe ratio model. However, when you look at how the deciles perform over time, the Sharpe ratio had the behavior we just showed. However, the new model actually does well on those early regimes as well. We get the proper spread between the deciles. And so you see, if you look at the middle plots here on the Sharpe return model, both of those were negative in the early regimes. Now look at them here in the just predicting the returns. And you see it's positive in those regimes. And so I feel better about this model. And so I went through and I've been doing portfolio strategies on this model. In this PowerPoint, I'm kind of refining that. So just going through all sorts of simple things with a very simple model. But I made some changes yesterday, actually, to how the portfolio strategy is being implemented that do improve it a fair bit. So, yeah, if you see that if I just do 4 positions here and I don't do any scaling, I get this really good looking returns chart, 60x returns over 12 years. Obviously, that's unbelievably good. And the worst drawdown actually is only 35%. Well, exposure stays near the maximum. So, This is really good. Uh, so I'm gonna go through and try to see, can I bring this drawdown duration down at all. Um, yeah, so that's what I'm working on. And I'm looking into the volatility here. So these are my to-dos. So I implemented yesterday, I finished this. So I did the Yang Chang volatility estimator. So let's make this green. Now we need to try EWMA volatility. The range-based estimator I'm not going to worry about. Okay, so let's see. EWMA with Yang Chang. Good morning, Hike. All right, so yeah, this will be interesting. No, I did some optimizations overnight last night, so let's test those. So if I go back to the optimization, what was I optimizing? From 2016 to 2022. All right, so let's put that in. All right, so let's put those parameters in. All right, then let's run that. So let's do 2 longs, 2 shorts, hold for 5 days, rebalance every day, look back 150, smooth, false, buffer multiplier 1.4, cost BPS 15, sizing method, beta neutral, volatility type, Yang Chang. Oh, crap. Oh yeah, so I need to do that optimization with the Yang Chang volatility, but that wasn't happening. So we need to rerun that. All right, so back to optimize. HRP backtest, and then let's add volatility type is equal to. Oh, but it shouldn't matter actually because we're only scaling information coefficient. No, I'm not making for the S&P 500, but it's kind of a proxy for the S&P 500. So it's only common stocks like Apple and Tesla, real estate investment trusts, and ADRs, which are foreign companies listed on the US market. And then the top stuff by dollar volume. Um, but I have over 1,000 stocks in my universe every month, so it's not exactly the S&P. It's more encompassing than the S&P. Okay, so we could go back to implementing this. So buffer multiplier 1.4, sizing method beta neutral. Oh, there is a target volatility. 0.1. Yeah, but I didn't make it Yang Chang. All right, so let's actually add that here. Have you added a relative strength index check based on volume to check how much a stock is moved and less down and up to get how much a stock is volatile? Yes, I do have relative strength. Well, it depends what you're talking about. I'm not sure what you're referring to as in terms of where it's incorporated, but I do have relative strength index as one of the features I'm feeding into my model. Okay, so what do I want to optimize first? Okay, this will optimize just the information coefficient. So that should be simple. If we use just the information coefficient, can we find some optimal parameters? Yeah, okay, that should work well. All right, so never mind. That didn't improve anything. Okay, so now let's implement EWMA volatility. But first, let me go to the bathroom really quick. Okay. Yeah, referring to getting information using relative strength index to find a stock is moving or volatile, which gives a better return as per volatility, which avoids and gives an approach to get a stock. Yeah, well, that's kind of the light GBM is basically a tree model that's deciding how to make decisions. So that's going to be incorporated into the model, but they're all the features have a different importance. So I'm not sure if that's like the prevailing. I'm assuming that's not the prevailing mechanism. Or at least I think that's a fair assumption. So, you could take the raw variance. Anyway. Instead of applying feature on a random stock. So I'm not sure what you mean by that. Do. Yeah, I'm not sure what you mean by that. Okay, good. So it works right. So. How's this looking? Yeah, so 0.46, that's not so bad. So let's see what this gives. This is going to take quite a while to run though. So what is this? I don't even remember what this is showing. But the results are good. Yeah, this looks like a pretty good strategy. But I think it had a long drawdown duration. Yeah, 645 days. All right, so while the optimization's running, let's add this EWMA volatility estimator. Add EWMA to the allowed types. All right, that's pretty easy. All right, let me put some music in so I can get into concentration mode. Let me know if you guys have any music recommendations. What EWMA does an estimator? Well, I'm losing it. Okay, thanks, Soulwater. EWMA is a volatility estimator. That's a very common song name. Who's the artist? I'm losing it by who? Alright, so we have new HRP and old volatility. New HRP with IC only. Fisher. Okay, good. That's the top one anyway. Okay, so those are the optimizations I have to do. Optimization with new HRP and old volatility. Now I did actually get that here. Oh, but I don't know when it's optimized from. So I'm going to have to redo all the optimizations. All right, so let's go back to init, 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 run, init. Okay, so we could also have EWMA. Add EWMA, scroll down to data fetching block. I just want to see as soon as my systems start making some money on an Indian stock, so I'd keep it running 24/7 then. Yeah, but the Indian market's not open 24/7, is it? Smoothing, is that in here? Nope. Okay, so before this else block. Now we have an error. So it should go before that else print warning. Oh. Yeah, so you could take out that bottom warning because that's already implemented. Okay. Six hours? The market's only open for 6 hours? That's like not much time at all. I guess the US market is open 6.5 hours. Yeah, why isn't the market open more time? Oh, nice. Yeah, if you use foreign exchanges, you can go 24/7. EWMA. No inside of run. So we have if else. So now let's just put elif. Then update plotting. Just another elif. How does your feature a market regime work? So I have there are a couple of regime features. The look up, I think it's called ATR. Let me remind. I forget if it's ATR or DR. Oh, average true range of the market. So that helps classify the regime. That's my most useful regime feature. Every time I run the model, when I print out the feature importance plot, the ATR is always my most important feature. Alright, so this guy's still going. Are we improving? 18 out of 21.6. Okay. Let's see if we can get above 1. Ideally, I'd get above 2. Okay, so now EWMA should work. So we can say... Yeah, but I will refer using for now Hurst exponent. Search it. Yeah, I know the Hurst exponent, but that doesn't tell you about regime, does it? Oh, yeah, sorry. Hurst exponent does. Hurst exponent, right, is the one where if it's close to 0, it's mean reverting. If it's close to 1, it's trending. And if it's 0.5, it's just noise, right? That's the Hurst exponent. But the Hurst exponent isn't my most important parameter. All right, so let's try turning scaling off for now. Let's go back to 5 longs, 5 shorts, hold for 5 days, rebalance every day, look back 150, smooth, on, buffer multiplier 1.5, beta neutral, EWMA. Okay, good. Well, this will be the same plot when I don't have scaling, but that's fine. All right, let's make sure this is on. And then we can run it, and let's see how it does. So this will be... Hey, Sir Night Night. So I did your Yang Chang volatility estimator. Now I'm trying to do the EWMA volatility. Um, so what do I draw? I don't know. I forgot. I didn't document this well yesterday, so I need to look more into this. But basically, my finding from yesterday is the Yang Chang is still not responsive enough. If I add that volatility scaling in, it makes it worse. But I need to run some more simulations of this because it's documented pretty poorly. But um, yeah, I guess the good thing about Yang Chang is I could get the volatility down. or the worst drawdown here, 25%. That's better than I was getting with the last volatility estimator. But now I want to see how EWMA works. Alright, so here's the EWMA volatility. It'd probably be good to just compare different volatility types. Yeah. Yeah, so I think I'm going to do that. I'm going to get all of those into a plot. So let's make... So this will just be the unscaled portfolio. 5 longs and shorts. Okay, so let's do... an HRP backtest. So let's make a new folder. So we're in Explorers. I'll just put in today's date. And then we'll say this thing again. Let's add in portfolio when we plot. So first we show the volatility, and then we return. So if we have Yang Chang volatility, vol series, vol series, vol series. Okay, good. So I'll just say plot dates vol series, or return. All right, so then we plot the volatility. So I'll say dates vol series is equal to that. And then we'll say df is equal to pd.dataframe. And let's put those into a dictionary. Date volatility. And then we'll save it. df.to.csv. Alright, so let's make a new directory here. Data. Alright, so we can save it to... we're in Portfolio Explorer, so we can just put it right into volatility. Underscore 2026 0525. Is the repo updated? No, but I can update it really quick. I think this is the only thing I've changed. Yeah, so let me just add this. Added different volatility estimators. Yang, Chang, and EWMA. Okay, now it's updated. Do 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 do. what this tool helps. What do you mean it definitely will. Spread won't make that much of a difference at the daily time frame. EWMA may be overfitting. It definitely will if you're trading intraday. Oh. So you mean spread scaling from spread? I found that spread and information coefficient don't really do much for me. Volatility at least lowers the drawdowns. Volatility 2026 slash data slash EWMA.CSV. Okay, so let's try saving that. And then I need to install so I get the new portfolio. Then let's go back to Explorers. And let's go to volatility. Okay. I guess I don't want to be there. I want to go back to Explorers and do portfolio. The Yang-Chain is optimized for efficiency and handling overnight gaps, not necessarily for speed, but you can improve that by replacing the simple window with EWMA. Yes, that's what I'm trying to do. Oh, EWMA within the YZ estimator. That's what I asked the AI about that earlier, but it said that wasn't a good idea. Now I wonder why. Wait, did I lose the tab? Yeah, where'd the AI go? I guess it disappeared. All right, let's see where this guy's at. 0.63 still, but best trial is 34 out of 39, so it's improving steadily. All right, I have to go to the bathroom again really quick. Okay, so here's that volatility. We have it saved now. Let's see if we have it saved. Oh. Volatility underscore 20. Oh. 0525. Alright, now we should save the data. And yeah, I need the volatility on the unscaled portfolio, so this is just going to take a little bit of time. Anyone watch India market? No, I do not, personally. Josie's on a vacation far away. Come around and talk it over. Shared the auction schedule Excel on Discord. Nice, I'll go take a look at it. My girl's a little bit older. I just want to use your love tonight. Alright, let me see. Where is the auction? Oh, here it is. I don't get what this means. Auction day. What does that mean, auction day? There's me, PGL3. I'm auction day 2. Alright, so we want to get the volatilities and compare them, and then explore around different volatility strategies. From shaking. Okay, so here's the volatility. Let's see if it saves. Good, it saved. Alright, now let's save Yang Chang. Yang Chang. Tonight. Yeah. This is saved, right? Yep. Good. Alright, so now in Explorers, let's go to that folder and make a new file. Okay, now here's the Yang Chang volatility. See if it got saved. Yep. Oh, but I don't want this to be in data. Oh no. How stupid. Man, I'm not working well today. Everybody wants to rule the world. See ya, Hike. See ya, Soulwater. Okay, I'm gonna go make a coffee real quick. I'll be right back. break them up. Yeah. Hi, buddy. Alright, so here's the simple volatility. Now that should be the only one that's saved. So let's see if it's saved. Do it for magic. It's your time, baby. Hey, G Spider, how are you? Murder the basket. Steal the ball back. Hold it for ransom. It's more than a game. This is a passion. Been an all-star. Been a champion. You hear him chanting. MVP. MVP. Kobe Bryant, aka MV me. Any deep smash, any D. Whoever he is, he can't guard me. Alright, we don't need any of that shit. Why are there two columns for the dates? Oh, oh, a life worth fighting for. Oh, him. Alright, so I need to compare these different estimators. And then let's just do a 5-position portfolio with EWMA. What's the computer at? Maybe I could just run a different script. Oh, memory's good. CPU's fine. I just finished this one. So there's the Yang Chang volatility. Finally, let's do EWMA. All right, and then I want to try EWMA. So let's set that up. So let's do EWMA. Oh, a simple volatility, but I guess I want to see what the volatility levels are. All right, so let's write the script. Explorers, volatility, compare vols. All right. You're going to have to pull in data from a lower time frame, like 30 minutes or 5 minutes, to improve the responsiveness. Yeah, that would also let me do the actual Yang Chang calculation. If I had minute data, then I could get the actual highs and lows of the portfolio. But I don't know. That's a huge problem to figure out because minute data is hard to get, and I have the requirement where I want to use only free data. So, daily volatility. All right, so here's the EWMA. So where's this? You see, EWMA, actually, this is interesting. There's a very clear regime change in volatility. So basically you get these two different regimes. So let's say I want to set it here. Yeah, so when do I start trimming volatility? I mean, this is cutting through. Yeah, we could try 30 also. Okay, so we're gonna do scale on, target 0.3, look back. I guess we could do 20 days, but it might be 5 days we want to do. Oh, it's ignoring the look back with EWMA, so it doesn't even matter. False, false, 111. All right. So let's run this. And then let's write this. Comparing volatility of different estimators. I'll say from different estimators on unscaled portfolio for model 28 walk forward. All right, so from matplotlib, import pyplot as plt, from, I'll just say import pandas as PD, then we could say volatility types is equal to simple EWMA. Let's make sure they're all in here. Yep, good. Simple EWMA and Yang Chang. Colors is equal to blue, green, red. And then we'll say for color volatility type in zip colors volatility types, we're going to say df is equal to pd dot read csv data slash, make this a f string, data slash vol type. Oh, what do we call these? Yeah, dot csv. PLT. All right, so let's see, how did this do? So this is a simple strategy with 30% volatility target. You can see there's two real scale downs. $498-day drawdown. Baby, treat girls and boys, but you can never stop the feeling. So it's not doing anything. Let's just try 0.25. 0.25. Just to stop the feeling. df is equal to that. Then we can say plt.plot df dot date df dot volatility. So you see here in recent times, it's below the volatility threshold basically the whole time. Hey, Sam. Well, that's my hope. So there's not too much of a difference between EWMA and Yang Chang. There is a big difference between those and the simple volatility. Yang Chang's always higher in the early regime. So Yang Chang looks more consistent. All right, so but the Yang Chang are not really improving anything. But that's our best bet. So if we go back to Yang Chang, three-day look back, 0.2, 20% target volatility. How does that do? And then we could forget about the saving here. Take only what you need from it. And the EWMA is a whole measure above the simple volatility. YZ is a whole measure. Yeah, well, that makes sense. You know, basically it seems here like Yang Chang's the best because the EWMA has a lot more of a slope to it. There's a clear regime change in the EWMA. Yang Chang, there's a regime change, but it's not nearly as extreme. And so I feel like that's more reliable. You could use a single estimator. Okay, so we need to. I'm not sure about doing the optimizations with the other estimators anymore. Yang Chang seems like the best. Um, Maybe I could do that same exploration. Well, really, I should do 4 positions, right? Okay, so let's see how this performance was. Oh, here are the results. So still 5x returns over 12 years. Is that good? Average annual return is 15%. That's not so bad. Worst drawdown was only 18.9%. Duration is shorter too. We're up all night for the sun. We're up all night for good sun. But exposure goes low. I don't know, that looks pretty good though. Alright, so that's going to be it for now. I'm going to keep working on this later today. In my stream I do later today, I'm going to finalize the day trading stuff, or the paper trading stuff, so I'll be ready to paper trade starting tomorrow morning. But that's it for now. Thanks for watching. Don't forget to subscribe if you think this is interesting. I work on it every day. And have a good rest of your day. Adios.